Okay, this video I'm gonna just be talking about the fundamentals of forex trading. Be talking about what is a pip, what is leverage, and how to read candlesticks. So let's get into it. This is just how to read pips. So how you read pips, basically. Let me go to this tool right here. I like reading it in ticks. I don't like reading in pips, but I'm gonna just explain both right now. So as you can see right here, 10 pips is 100 ticks from where it started at right here. So when it's always, let me move that out the way. When it's always 10 pips is basically 100 ticks. So basically, let's say your lot size is $1. If you put your lot size as $1, it's gonna be $100 when it hits up here. So 10 pips with $100 is, 10 pips with $1 is $100. So you would just do that math over and over again. Like 20 would be $200, and so on and so forth. I like reading it in ticks though. So basically, if you would read it in ticks, 10 pips would be 100 ticks, 20 pips would be 200 ticks, and etc. So you actually want to use your pips to get your RR, and which is what is the RR is win to reward ratio. So if you, as you can see right here, pips is something you would just do simple math on. So you would use your pips and your lot size to calculate how much you'll lose and how much you'll win. So you could easily do that with a calculator, or you could actually go to a website and look it up. So here you go. This is a pip calculator. So basically, this is a pip calculator. So this is what you could use if you don't necessarily want to use a calculator or want to do it in your head. Once you start trading a lot, you'll be able to do it in your head though. I can do it in my head, but so let's say Euro USD, right? Let's do X that out. Let's do about 10 pips. Like I was saying, lot size is $1. See, $100, like I said. So the thing is about this is it's definitely different on JPY pairs. It's very different on JPY pairs. It's not that simple. The math on them are kind of off. I don't know why exactly, but the math on them aren't the same as a USD pairs. So let me go show you what I mean. I'm gonna go to let's do that one. So a lot B1 still 10 pips, right? Look how much it is, $66. So it's definitely a difference. So when you trade JPY pairs, you want to make sure you pay attention. When you do JPY pairs, you want to make sure you pay attention to how much you're risking, because it's not as that much. So you might have to double up. Brokers usually offer more leverage on JPY pairs because of this. But yeah, you want to watch out for that. JPY pairs are not the same as USD pairs when it comes to pip calculations and even ticks. So I don't know what that is about. I can't really explain it, but it's definitely different. And that's with all JPY pairs. I can show you another one. We can even do USD JPY. It's still the same thing. Still the same issue. So you would do 10 pips. Yep. As you can see, still the same. So any pair with JPY in it is going to be definitely a different amount that you win or lose. So you want to actually pay attention to that. How I used to calculate, I used to times it by like a half or something like that. But it's easy to do it in a pip calculator like I'm showing you now. You just go here, put in your pips, put in your lot size, and boom. Over a while, it should be better. You should be able to do it in your head. If you actually can do it in your head, you can place trades faster instead of always coming here when you're trying to place a trade. But when you set up a trading strategy, it should be where you don't need this. It should be like you already have set everything you need to set. You know your pips and you know your stop loss. So you would be like, oh, okay, I know I'm going to win this amount of money every time and lose this amount of money every time. Because your trades would be kind of similar majority of the time, like maybe even 3 months. Like even me, I'll set up a trading strategy and run it for 3 months and do the same thing for 3 months. If I got to change it, I'll change it. So I would suggest you do the same or have some type of strategy where you can just keep running over and over again. Um, yeah. So let me see what else I got. But the reason, I think one of the reasons why JPY pair moves like that, I'm gonna show you. Um, because they move faster than a lot of other pairs. They have bigger moves, and bigger pips. I mean, really bigger candlesticks. So as you can see, maybe I can put two to the side, but when you do look at both of them, like let me show you. Let me go to the 4 hour, right? Let me go to the 4 hour here. All right. So you can see, let's say just 8 hours ago, like you have here to right there. That's about almost 2,000 pips. Not even 2,000, just 1,000 pips. But if you go to Euro USD, look how slow it's been moving this whole time. It's been moving really slow, and it consolidates a lot. So I think that's why the amount is different, because JPY does move faster. Yeah, JPY does move faster. Like even Euro JPY moves really fast. So I think that's another reason. But yeah, let's get into candlesticks. So now I'm gonna get into the candlesticks. So how to read candlesticks, right? So I'm gonna state the obvious, then I'm gonna start talking about other things that I see when it comes to candlesticks. So this is what I see when it comes to candlesticks. I'm gonna zoom in real quick. All right, so I'm gonna go to my 15. So these are your time frames up here, obviously. So basically, if you set a 15-minute time frame, that means each candlestick is 15 minutes. Each of them is 15 minutes. And as you can see, it does the same for the rest. Each of these are 30 minutes. Each of these is an hour. So right here, I got a brain fart. What that was. So as you can see, yeah, green is up, red is down. And also there are different candlestick settings you can have. I'm gonna show you that now. It's different candlesticks, so you can actually have this one right here. I think, yeah, this one right here. A lot of people use this one. Take that off. A lot of people use this one. This is like a more of a trendy thing if you're into that. This shows more of a trend. If you combine this with indicators, it's a good strategy. I don't think people really use this alone. I never used it alone. I used it with an indicator or something. But this is good if you combine it with an indicator. So, and it's basically like a trendy thing, as you can see. But at the same time, the rules still apply. Like each of them is whatever the time frame is on. So each of them. So basically, each of these are a day. So if you would go to 30 minutes, 15 minutes, each of them be the same. The same rule apply. Green is up, red is down, and let me go back to the regular candlesticks. Boom. So one thing that I see when I be trading that I want to share is that I be seeing price will make a big move. One candlestick will make a huge big move, and it'll come down, back down. Like here, I think this is gonna come down at least right here over time. It might even happen more recently, but I think it's gonna come down there. But I want to show you an example. See how price is. It made a big C. That's what I mean right there. That's what I be seeing. I be seeing things like this. Price will make a big move in a short period of time. This might even happen in like 15 minutes or something like that. I'm finna go check, but it'll make a big thing at a short amount of time, and it'll come back and collapse and close it below, because that was a big jump, and that's when probably a bank got in or something, or an institution or something got in, and it made a huge jump in price. So price does have to regulate itself. So sometimes it'll come right back down, or over time come down to below here, or close below this whole candle. So as in, I mean, for example, like you see, this is a buy candle. So if you bought right there, you would have won money. But if you do like see, it's a sell. If you do a buy, boom, it went down. So like I say, if it was a sell and went down, over time it would probably went back up. Let me see. See here, that's a big candle right there that dropped, and that was significant. See right here, and look how it climbed up, and it went over that. So you do want to, if you're trading, you want to see like big moves like this, and these did happen over a short period of time. Like I'm sure that happened in 15 minutes or maybe even 5 minutes. And once that happens, something like that happens, you want to just, sometimes I see that. Most of the time I really see it close that whole price and get back to normal, because that jump is from an institute or something, or a bank or something that just went ham right here in this area. So then you have gaps too. I don't see any gaps yet, but you have gaps in, see, look, gaps closes. Sometimes price it'll have a gap, and it'll close the gaps, as in like right here, you see the gap was right here, it went down, closed the gap. Let me see if I find another gap, for example. I want to see if I find a buy gap and not a sell gap. See right here, a gap closed, it closed the gap by going up. If it was see, so that gap got closed going up, and that other gap that I just showed you got closed going down. Another gap closed going up. So it's cool to see that gap right there would have been closed going down, because it started from right here, so you would have closed it going down. So it closed it going down, but it did, yeah, it closed it going down. So gaps too are a strategy that people use too. Sometimes they'll get in when they see a gap, and they'll close the gap and take out profit when the gap is closed. So your gap would be closed right here. That would have been the gap closed. You would have got out right there. I don't know when you would have got in. You might would have got in. You can't really get in at 5 o'clock when the market opened right back up. I know it say 9 right here, but when a gap usually happens, it usually happens when the market opened back up. So that's on a Monday. No, on a Sunday at 5 o'clock. So depending on where you at, it might be 6 o'clock where you at. But if it does that right there and it jumps, it's going to come back and close. And sometimes people actually trade that. So it can come back and close, and that's gap trading. Some people trade the gap. Certain special candles that you can see, like a doji candle, that usually means something. Like a doji is this right here. You have to be consistent on the time frame when it does it, but you'll pick a time frame and find a doji candles. So let me look for a doji. Basically looks like a you would say X. So let me first. All right, so this is a doji candle. So the idea about a doji candles is when you see one that's red, it's most likely price is going to shoot down. Most likely when it's green, the price is going to shoot up. And the doji is like I said, it's like a plus sign. I said X, but it's like a plus sign really. And if you see that, that means prices might make a big move up or down, but depending on how to close. So if close red, it's gonna make a big move down. Close green, gonna make a big move up. That's another strategy people use. Yeah, and this is like for sure something most likely is gonna happen when you see something like this. Like sometimes it does close and it doesn't even have a color, so that's a good sign. But you at the same time, you'll have to probably zoom in on your chart to see what color it is and place your trade like that. Same thing for all these where it's white, you would just zoom in to your trade. To your chart, zoom into your chart, and you'll see if it's red or green, and you go ahead and pick the direction. That does look good when it's news happening. You can go look up news too. There's news events, and if that happens with a news event, it's definitely probably something crazy is gonna happen to the market. But usually when you trade like that, you want to get in and out, so you don't want to be over one candlestick. You probably don't want to be in a trade more than an hour, maybe two at most, because it's a real quick move. It's not a long term setup at all. It's a real quick move. And another thing I want to say is when you use your indicators with your candlesticks, with certain candlesticks, like the doji, I like the doji. You have candlesticks like the hammer, shooting star, and stuff like that. But I really see price really go crazy off of doji candles. So if you pick a candlestick and use an indicator with it, I showed you another candlestick thing where it was just showing green and red, and which was the trade and the trending one. I'm gonna pull it back up so you'll know. But if you mix an indicator with this, mix an indicator with this right here, yeah, you'll be going like, it'll be really cool, and you'll probably, because this tells you where it's trending at, so that's a good thing. And you kind of want to understand candlesticks and get good at candlesticks before you add in indicators, because indicators are just a supplement. Price action is like what's going on. It's a supplement too. So basically everything is a supplement, because I say everything is a supplement because nothing is 100% right. So you're trying to get as close to it as possible. So it's just a idea at that point. So you just want to use as many supplements that make sense, not overdo it, but definitely have at least make sure your chart was looking, because all you really need on your strategy is an exit plan, entry plan, really just an exit and entry plan. That's all you really need, because if you don't have an exit plan, meaning stop loss or take profit, you don't know when you're gonna get out. And if you don't have an entry plan, you're never gonna get in. So you definitely need those two things. Now I'm gonna get into leverage, right? So leverage is it's not confusing at all, but I just want to say leverage to me is very important. You can overdo it if you have a 1 to 500 leverage or a 1 to 1,000 leverage. I've seen that before. I don't know if that's even a thing anymore. That used to be back then when MetaTrader had unregulated brokers, and on unregulated brokers, you could have a 1 to 1,000 and 1 to 500 leverage, which was basically your whole account. You could risk your whole account on one trade. But especially on 1 to 1,000, you could risk your whole account on one trade. So, in 1 to 500 was basically half your account on one trade. So basically, like now on regulated brokers, you have like 1 to 50 leverage, and that's good in my opinion. That's like more like probably 5% of your account on one trade, I think, because if 500 is half your account, I'm just doing a simple math from what I seen. Like 1,000 is your whole account, 500 is half your account, 100 would be 10% of your account, and 50 would be 5% of your account. So you'll be able to risk 5% a trade on your account. So you can risk 5% on each trade on your account, but you only can risk 5% at a time, basically. So you can only risk 5% at a time. So with 1 to 50 leverage, once you use your 5% on a trade or how many trades it is, if you have 5%, if you're risking 5% of your capital and it's open, they won't let you trade. But like when you got 1 1,000 and stuff like that, you can keep trading until your whole account is like not blown, but you're definitely gonna probably blow it off that, but not blown, but to almost like your whole account is in use, basically. So you have your leverage, you have your margin, and you have your free margin. Margin is what's already being used. Your free margin is basically how much you got left to use. So you can have, then it depends, all that's like a whole only math thing. All that is its own math, like margin, free margin, and leverage. I'm just telling you what it is. Leverage is like your best friend and enemy, but I don't think you should really want to high leverage. I think anything over 1 to 100 maybe even 1 or 200. But anything over that, when you get to 500, especially when you get to 1,000, it's more tempting to blow your account. With 1,000 leverage, you can definitely blow your account, but you can double your money though. You can double your money. I'm not gonna sit there and lie like you can't. You can sit there and double your money off that, but I don't know if they're even doing that anymore. Regulated brokers are only on MetaTrader 5 now and MetaTrader 4, so I don't think you can even have or leverage that high anymore. I think you have to go regulated. But if you're in different countries, I'm sure that your regulation is definitely high. Your leverage is definitely high in other countries. Just in America, is about 1 to 50. Other countries might be like 1 to 100, and maybe even higher. I haven't really checked because I'm in America, so it's I'm just worried about what's going on in America for real. So like I said, leverage is how much you can use, and I did the math on that for you. Margin is how much you can use. So when you place a trade, it's margin is like how much you can use. So over like more trades you place, the margin will get lower. Especially the same thing with free margin. A free margin is how much you got left.